Realty Income Corp., the monthly income payer and possibly the country's best real estate investment trust, is currently on sale. This video will show you why you should strike while the iron's hot. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. You know, the oldest rule and probably the best rule of investing is buy low to sell high. And, you know, when you get that opportunity, it really makes sense to take advantage of it, especially when you can buy extremely high quality merchandise at a bargain basement price. I believe that's the situation with Realty Income today. Not only is the company on sale, but it's going to be bigger and more profitable, I believe, in the future than ever before. Let's go ahead and get into the fast graphs and look at the opportunity today in Realty Income. I'm going to look at Realty Income Corp. From the perspective of operating cash flow on your fast graph if you're a subscriber, which really delivers funds from operations, which is the primary metric you want to look at with the REIT. All right, and as you can see, the funds from operations Realty Income have been very consistent with a growth rate of 5.31%. And the company has paid out a very large portion of their funds from operations. It also makes sense to look at free cash flow to equity, which is adjusted funds from operations, which many REIT analysts prefer. The only problem I have with adjusted funds from operations, just so you're aware, is that it's not as standardized as funds from operations. But both of them provide what I would call a fair look at a valuation reference for REITs. Now, another one that I like to use, which I'll talk about also, is EBITDA. Okay, EBITDA, FastGraphs only produces the normal or market EBITDA, and we'll look at Realty Income from that point of view too. But let's start with operating cash flow. That's the orange line on the graph, and this is at 15 times funds from operations, which gives us a funds from operations yield of 6.67%. So anywhere the price is above that line, I would consider Realty Income overvalued. Anytime the price is below this line, I would consider it undervalued. Okay, so let's put weekly closing stock prices on the graph here now. And what you get is a very clear picture. Now, in 2004, coming into the Great Recession, you had many, many opportunities to buy Realty Income at what I would consider to be fair value. Now, remember, the point about fair value is that it allows you to fully participate in the growth of the business, which is what this orange line actually depicts. Okay, it doesn't necessarily mean you'll make or lose money, because that's going to come from how fast the business grows, plus the valuation you paid for it, plus the dividend. Currently, the dividend yield is 6.27%, and it's actually a little higher. Yesterday's close, Realty Income was down 1.59% to 49. A quick look at today, going to Google Finance, and we'll see that it's down to 46.24. And the yield now has gotten a little bit higher than what it was yesterday. Okay, and it's down 5.63% as I'm doing this video. All right, there's a reason for that, and we'll cover that here in a moment. But the bottom line is, if you bought this REIT back in July 16th of 2004 at a 13 price to FFO. Right now, it's 11.96. So you would actually have some price to FFO contraction. Thanks to the generous dividend, you would have still made 8.06% over the years. Now, your $10,000 investment would have grown to $25,299. And I want to overstress here that the stock is now below the orange line, and this is probably the worst time you could be evaluating Realty Income over this roughly 20-plus year period. In addition to the, profit turning $10,000 into $25,000, you also received an additional $21,000 of dividends. Now, not reinvested. Remember, this company pays monthly income, right? So your net investment on a $10,000 investment made on January 9th, 2004 through yesterday's close would have averaged 8.06%. Now, I want to make a point. If I go back to this here and look at it on the same date, let me get the same date, all right, January 9th, 2004, and I valued it at what I would call fair value, which would still be a relatively low valuation for the stock, then the return goes up to 8.19%. Valuation matters, and it matters a lot. But I want you to notice something about Realty Income. It's been very, very rare that you had an opportunity to buy it at this low valuation. The market over this time frame has applied about a 17.5 multiple, which is here. And even then, I want you to notice the multiple on Realty Income was often much higher than that. This is a very popular REIT. It's A- rated, only has 40% long-term debt to capital, and again, yielding over 6% now. All right, so this is the opportunity that I'm talking about. We now have a margin of safety for the first time since the Great Recession to invest in Realty Income. Now, there's going to be a lot of skeptics and a lot of ne'er-do-wells who are going to say, yeah, but REITs are dropping because interest rates are rising and they're not worth as much. I don't consider that an accurate statement. I do believe that the market value of the REITs has dropped because of maybe the rise in interest rates, and that's really a problem of perception. People are perceiving REITs as not being as attractive as they were at lower interest rates. But the analysts still expect this company to grow at 2, 3, or 4%. Currently. And let's look at forecasting real quick, okay, which is, the leading analyst. The forecasting calculators on Realty Income show pretty consistent expectation of about 3.5% growth going forward. But now I question this. Now, the analysts have been right 100% of the time on a 1-year forward with a 10% margin of safety and 100% with a 20% margin of safety when they were making estimates 2 years in advance. So let me be clear about that. All right, when I'm looking at this, and I'm looking at the forecasting calculator, all right, this is roughly 2 years out. The analysts have been right 100% of the time. And I also want you to notice that the estimates have stayed in this 425 to 430 range. They currently expect 425, and that's probably discounted a little bit because of interest rates, but companies like Realty Income can adjust those interest rates. But right now, you've got a very strong margin of safety. Now, the normal multiple on this stock over the last 5 years has been over 20. I want to make that point so you understand. If I go down to 7 years here, and that includes the 2 years of forecasting and roughly 5 years of history, we got a normal multiple of about 20. And you can see, other than during COVID, the market did apply a higher multiple than 20 on Realty Income. So I'm very excited about this because I really have always liked this REIT. I do consider it to be the world's best REIT, or certainly America's best REIT. But the problem is you almost rarely get an opportunity to buy the stock on sale. And, you buy low, be greedy when others are fearful and fearful when others are greedy, as Warren Buffett so aptly put it. All right, so my point being here is now we've had interest rates serve as a catalyst to bring the price down. The fundamentals haven't really changed very much, but something has changed dramatically. And the reason Realty Income is down today, and let's go to Yahoo estimates this time and see how it's doing. It's down 5.5%. It was down over 6% earlier. It's trading at 46. And if I go into a summary here, look at the stock right now, the dividend yield as of this current price, let's see if I can find it real quick. The dividend yield is 6.27% with a $3.07 dividend. And that's basically what we have in FastGraph. That's based on yesterday's close. It'll be a little higher than that now that the stock is down an additional 5 or 6% today. But what's the news on Realty Income is they've announced that they're going to buy Spirit Realty in a deal valued at around $9 billion. Now, Spirit Realty, if I look at it today, is also a pretty good REIT, but it's up 8% today. And my point is, by buying Realty Income today on sale, you're getting the advantage of Spirit Realty. And I want you to notice they've made this announcement. This has a $4.5 billion market cap. I don't know what the exact numbers are going to look like yet, but the point is they're going to be buying Spirit Realty Capital at a very good valuation. And Spirit Realty is also not expected to grow very much. But I believe once it's put in the hands of Realty Income, that they'll be able to get some synergies here. This company has obviously done a very good job of blending mergers before. And I think Realty Income and Spirit make a great combination. And so I think the fact that the stock is trading so cheap now, and you can buy it even cheaper than what this graph shows because it's down another 6% from what this graph shows, we're looking at buying this stock with a nice margin of safety, and that gives us the ability to make 20% annualized rate of return, including dividend, and we get a very high dividend yield, even relative to what corporate bonds are. And I think this is a great time to buy Realty Income. If the market goes back to putting a premium valuation on it, you stand to make almost 40%, 35+% owning Realty Income. So I believe this is a great time to buy this great REIT. The combination of Realty Income and Spirit Realty, I think, make a lot of sense. Now let's go and look at the corporate website of Spirit. All right. And we're going to look at their basic businesses. It's freestanding, single tenant, operationally essential real estate is what Spirit owns. And you can go in this, and look into this stuff yourself. And it's high quality, diversified, triple net lease portfolio is what they have. All right. So, you go into the website, go into their investor relations and learn more about the company. And of course, looking at Realty Income, they're probably one of the more famous REITs out there. They really have a strong track record of success. And, they also invest in, major properties, and they have made acquisitions in the past, and they've always been able to bring those acquisitions, with a synergy and, actually maybe enhance the value of those acquisitions. But I really like the idea that they're buying this company on sale today. All right. So, by buying Realty Income, you're going to end up getting Spirit Realty. It's cheap now, but it's up about 8% from here. But by buying Realty Income, you're going to be getting both of them when the merger, finally happens. Let's go into the external links. Let's go into the Wall Street Journal. And here's the article on Realty Income to buy Spirit Realty in a $9.3 billion deal. Okay. And so, the Spirit Realty is up 8.2% as we were looking here. The real estate company that Spirit stockholders will receive 0.762 shares of the newly issued Realty shares for each share of Spirit they own. And, at the closing, Realty Income will own 87% of the company, while Spirit shareholders will own the rest. Expected to close in the first quarter of 2024, which is obviously not very far from now. So I really like this deal. I would like Realty Income here if they weren't making the deal. As far as I'm concerned, making the deal is icing on the cake. But having the opportunity to buy this stock at this discount, despite what you worry about interest rates, interest rates are an expense for them. They'll be able to, renegotiate leases and everything else for the higher interest rates going forward. This company has, a fortress balance sheet. It's a very, very strong company. And you can go into Fast Graphs and go into the financials and, learn a lot more if you're a subscriber to Fast Graphs. But clearly, just by looking at this graph, this is a stock that, was trading coming into the Great Recession at a fair value of funds from operations. And even as I mentioned, if I look at it from EBITDA, which is another form, this stock normally trades at around 13 times EBITDA. You can buy it now at 9.8 times EBITDA. So any way you want to view this stock, I believe it's trading at a discount. As far as price to sales, it's also trading at a great discount to price to sales compared to what it normally was. And normally you pay in these very high 16 times sales and so on. Today you can buy it probably, I'd say, right close to less than 10 times sales, considering the drop in valuation today. So Realty Income is a great REIT. It offers both the great combo. It offers a really, high current yield. It pays monthly income, which can be very beneficial if you're in a retirement portfolio. It's grown the dividend. Let's look at the dividend growth of the company real quick. It's grown the dividend by an average of 5%, 5.23% over the last 19 years, and a compound growth rate of 5.14%. And as you can see, it's outperformed the S&P 500 even at today's low valuation. It's even considering that the S&P is still overvalued based on the normal valuation that the Standard & Poor's would typically trade at. So you're buying this company and looking at this company at its worst possible time from a historical performance, and yet it still outperformed the S&P 500 over the long run. And you get an opportunity to buy it now on sale at a discount with a high yield, and you get the benefit, or the kicker, if you will, of getting Spirit Realty Capital thrown into the mix. So, I like this stock going forward very much. I think Spirit Realty in the last several years has, last few years has done a lot better than they have historically, but yet because of high interest rates, it's also on sale. And so I think this is a great time for Realty Income to be making an acquisition like this. So if I were you, I'd start building a position, look to start building a position in Realty Income. And if we didn't hit the bottom and the stock fell more, I'd be buying more. You could start building a position. You can go all in. I think you can do any of those things today at today's valuation. I hope you enjoyed this video. If you did, give me a like. If you haven't subscribed to our YouTube channel, please do. And take a look at Fast Graphs. What a great way to analyze stocks and give you a perspective of what the value of the business is relative to how the market's trading it. Therefore, you can make smarter long-term buy, sell, and hold decisions through Fast Graphs. Thanks for watching. We'll talk to you guys again real soon.